Hi, everyone. In this episode, we will analyze the investment value of platinum and its future outlook under the context of gold rising to $3,000. First, investors need to understand the driving factors behind gold breaking through $3,000. Surge in safe haven demand, geopolitical risks, concerns about U.S. stock market overvaluation, and global central banks continuously purchasing gold, especially from emerging market central banks, have driven gold's safe haven buying. BNP Paribas predicts that gold prices may exceed $3,100 by the second quarter of 2025, followed by a pullback. Recently, gold's breakthrough to $3,000 was mainly driven by geopolitical risks, Federal Reserve rate cut expectations, and trade policy uncertainty, reflecting monetary properties and safe haven demand. Platinum, however, is mainly driven by industrial applications, such as automotive catalysts and electronic components, with its demand more dependent on global manufacturing conditions and the development of alternative technologies. Inflation and policy uncertainty. Former U.S. President Trump's tariff policies reignited concerns about inflation, leading the market to expect that the Federal Reserve may be forced to cut rates, weakening the U.S. dollar and boosting the value of real assets. Though February's Producer Price Index, PPI, data slowed, potential tariff impacts remain, creating expectations of stagflation. Gold's rise reflects the market's concern over inflation reemerging, and if this scenario unfolds, platinum as an industrial metal may face cost-driven price increases, but at the same time, manufacturing demand could be suppressed due to an economic slowdown. Technical strength. Spot and futures gold prices have continuously reached new highs, with the Relative Strength Index, RSI, not yet entering overbought territory. Technical analysis suggests that $3,000 is only short-term resistance, and a breakthrough could push prices to $3,100. Platinum's relative position in the market industrial demand differences. Platinum is primarily used in automotive catalysts and industrial processes, differing from gold's pure safe haven nature. Current global manufacturing PMIs have not significantly rebounded, which may suppress platinum demand. Limited price linkage. Although both are precious metals, the 2025 gold rally is mainly driven by monetary properties, and platinum lacks direct catalysts such as central bank purchases and inflation hedging. Thus, platinum's gains may lag behind. According to the latest data, platinum spot price only rose 0.6% to $990.25 when gold hit a new high, indicating a weak correlation between the two. Historical data shows that while gold surged 27% in 2024, platinum's annual gain was only around 15%, reflecting differences in market capital preference. Gold's price is mainly driven by safe haven demand, with its financial properties notably strengthening during times of economic crises or geopolitical turmoil, such as during the 2020 pandemic when gold prices surpassed $2,000 per ounce. Platinum, on the other hand, sees over 60% of its demand from industrial uses like automotive catalysts and electronic components, making its price more influenced by the global manufacturing cycle. For instance, during the 2008 South African mining strikes, platinum surged to a historical high of $2.90. Investors can use the gold-platinum ratio to observe and predict platinum's future trends. The gold-platinum ratio compares the price of gold to platinum. When the ratio exceeds 1, it indicates that platinum is priced lower than gold. Historical data shows that this ratio exceeded 1 multiple times from 2015 onward, meaning platinum was priced lower than gold during this period. In the coming years, the price ratio between platinum and gold may be influenced by several factors, including market demand, supply conditions, and the macroeconomic environment. Below are key observations and predictions. Analysis of platinum's future investment appeal focus on growth potential driven by industrial demand. Key role in the hydrogen economy. As the core catalyst in proton exchange membrane fuel cells, platinum plays an irreplaceable role in the hydrogen energy industry chain. With the acceleration of the global green energy transition, it is expected that demand for fuel cell vehicles will drive platinum consumption up by 500,000 ounces per year by 2030, accounting for about 25% of current global production. Japan's and the EU's hydrogen infrastructure investment plans, such as Japan's green growth strategy, will further strengthen this demand. Semiconductor and electronics industry expansion. With the widespread adoption of 5G communication and IoT technologies, platinum's use in high-end electronic components continues to grow. From 2024 to 2029, demand in this sector is expected to expand at an average annual rate of 6.2%, mainly benefiting from chip manufacturing capacity expansions in China and Southeast Asia. Understanding structural supply-demand imbalance. Long-term supply shortage pressure. Geopolitical risks impact platinum demand in various ways, particularly through the stability of the supply chain, price volatility, and changes in market demand. South Africa, the world's largest platinum producer, accounts for about 60% of global supply. Political stability in South Africa directly affects platinum production and supply. The country's energy crisis, strikes, and social unrest could lead to production disruptions, impacting global supply. In addition to South Africa, Russia is also a significant platinum producer. Due to geopolitical tensions, especially sanctions imposed by Western countries, Russia's platinum exports may be affected, exacerbating global supply shortages. Price volatility. Geopolitical risks often lead to concerns about future supply, driving up platinum prices. For example, South Africa's power shortages and rising production costs have caused many platinum producers to face losses, which could reduce supply and further push up prices. Market sentiment is also influenced by geopolitical events. When the stability of a region is questioned, investors may turn to platinum and other safe haven assets, increasing demand. Market demand changes. The demand for platinum in the automotive industry is closely linked to the health of the auto sector. Geopolitical risks can affect automotive production and sales, thereby influencing platinum demand. For example, the rise of electric vehicles has reduced the demand for traditional internal combustion engine vehicles, which may affect long-term platinum demand. Industrial demand for platinum is also influenced by geopolitical risks. As global demand for clean energy increases, platinum's use in hydrogen technology may become a new demand growth point, but this will depend on the policy stability and market environment of relevant countries. According to the World Platinum Investment Council, WPIC, from 2025 to 2028, the global platinum market will continue to experience an average annual supply shortfall of 769,000 ounces, equivalent to 9% of annual demand. Declining production efficiency in South Africa due to outdated mining equipment, with a 12% reduction in output year-on-year in 2024, is a key constraint. Diminished inventory buffer capacity. Exchange-traded fund (ETF) holdings of physical platinum have fallen from a peak of 3.5 million ounces in 2020 to 1.2 million ounces in 2024, a 10-year low. This has significantly increased price sensitivity to sudden supply disruptions, e.g., labor disputes or extreme weather. The future risks and challenges for platinum investments include sensitivity to economic cycles. Platinum prices have a 0.72 correlation with global manufacturing PMI indices, 2020 to 2024 data, higher than gold's 0.31. If major economies enter a recession in 2025, industrial demand contraction could put short-term pressure on prices. Technological substitution risk. Advances in low platinum fuel cell catalyst technology, e.g., Toyota's latest generation Mirai model uses 20% less platinum, may weaken long-term demand growth expectations. However, this substitution process is expected to take 10 to 15 years to significantly impact market balance. In conclusion, the price ratio between platinum and gold may continue to rise in the coming years, especially if gold prices surge. Although platinum demand may grow due to the development of the hydrogen economy, its price growth may not keep pace with gold. Therefore, when considering asset allocation, investors should closely monitor the market dynamics of these two precious metals and changes in their price ratio. Over the next 5 years, platinum's investment appeal will present a volatile upward trend. Green energy transition and supply shortages support long-term value, but economic cycle fluctuations and technological substitution risks will create periodic pressure. Investors should adopt a core plus tactical allocation strategy, keeping platinum's proportion in the precious metals portfolio between 15% to 20%, and closely track hydrogen industry policy progress and South African mining production data.